Every empire's endgame begins with a market that stops making sense. Not a crash, not a panic, something quieter. A hesitation in the one market that was never supposed to hesitate. A crack in the foundation that everyone pretends they can't see. This is what happened in Britain in 1976. This is what happened in Rome when the denarius stopped holding value. And this is what is beginning to happen now in the market that the entire global financial system is built upon. The United States Treasury market, the safest asset in the world, the foundation of every balance sheet, the collateral behind every major financial transaction. The market that, for decades, has absorbed unlimited selling without breaking. It is starting to behave differently. In October 2023, something unusual happened. Treasury yields spiked violently, not because of inflation data, not because of a Federal Reserve announcement, but because the market itself could not absorb the volume of selling. Liquidity, the ability to buy or sell without moving the price, vanished in minutes. Bid-ask spreads widened. Market makers stepped back. The system that was designed to be unbreakable showed stress. The Federal Reserve intervened, not officially, not with a press release, but through liquidity operations designed to stabilize what should have been stable on its own. And then the market calmed, and everyone moved on. But this is not the first time this has happened. It happened in March 2020. It happened in September 2019. It happened in December 2018. Each time, the pattern is the same. The Treasury market breaks, the Fed intervenes, the system stabilizes, and no one asks the question that history demands we ask. Why does the safest market in the world keep breaking? Because safety is not a characteristic. It is a belief, and beliefs erode slowly until they collapse all at once. In 1976, the British pound was still a reserve currency. The Bank of England still controlled global financial credibility. British government bonds, gilts, were still considered foundational assets for international portfolios. London remained the financial center it had been for centuries. The system appeared stable. The institutions functioned. And then, in a matter of weeks, that belief unraveled. The market stopped buying gilts, not because Britain defaulted, not because of war or revolution, but because the market no longer believed that Britain could manage its debts without destroying the value of its currency. The mechanics were simple. Britain was running fiscal deficits that required constant bond issuance. The Bank of England was accommodating those deficits by keeping interest rates suppressed. Inflation was accelerating, and foreign investors, watching the currency weaken and the central bank lose credibility, began selling. The gilt market seized. Dealers could not find buyers. Yields spiked violently. The pound fell 25% in months. Capital fled. The government was forced to approach the International Monetary Fund for the largest bailout in the institution's history. The conditions were humiliating: spending cuts, monetary discipline, subordination to external oversight. Britain did not lose its empire on a battlefield. It lost its empire in a bond market. The transition from global superpower to managed decline happened not through conquest, but through the quiet recognition that the financial system could no longer sustain the obligations it had accumulated. This is what imperial decline looks like. It does not announce itself. It does not arrive with speeches or declarations. It arrives as a loss of confidence in the core financial instrument that underpins the system. And once that confidence is questioned, it is never fully restored. The United States Treasury market is not collapsing. Not yet. But it is starting to behave like a market under stress. And history tells us what this means. The mechanics are simple. Every financial system in the world is built on the assumption that U.S. Treasuries are infinitely liquid. Banks hold them as reserves. Pension funds use them as collateral. Foreign central banks store their reserves in them. Derivatives markets rely on them as margin. The entire architecture of global finance assumes that treasuries can always be sold, instantly at predictable prices without disruption. This assumption is embedded in everything. Regulatory frameworks treat treasuries as risk-free assets. Basel banking rules assign them zero risk weight. Money market funds hold them as stable investments. Clearinghouses accept them as pristine collateral. The entire plumbing of the financial system operates on the belief that treasuries are different from every other asset, that they carry no liquidity risk, no credit risk, no volatility risk. When that assumption weakens, the system fractures. And it is weakening. The U.S. government is now issuing more than $2 trillion in new debt every year. The Federal Reserve, which spent a decade absorbing that debt through quantitative easing, is now selling it back into the market through quantitative tightening. Foreign central banks, which once bought treasuries automatically as part of dollar reserve accumulation, are now buying gold instead. China's treasury holdings have declined by more than $200 billion since their peak. Japan, the largest foreign holder, is facing domestic pressure to repatriate capital as its own debt burden escalates. The buyers are stepping back, the sellers are increasing, and the market is starting to move in ways it was never designed to move. The problem is structural. The U.S. fiscal deficit is no longer cyclical. It is permanent. Even during periods of economic growth, the government runs trillion-dollar deficits. Social Security obligations are accelerating. Medicare costs are rising. Defense spending remains elevated. Interest payments on the existing debt are now consuming more than $1 trillion per year, more than the defense budget, and rising. This debt must be financed. Every month, the Treasury Department auctions hundreds of billions of dollars in new bonds. And every month, the market must absorb that supply. When the Federal Reserve was buying, this was manageable. When foreign central banks were accumulating reserves, this was sustainable. But now, the Fed is selling. Foreign buyers are diversifying. And domestic buyers, banks, pension funds, insurance companies, are already saturated. This is not a crisis, not yet, but it is a signal. And history tells us that these signals do not reverse, they compound. Rome did not collapse because of barbarian invasions. Rome collapsed because its currency lost credibility. The denarius, once 90% silver, was debased over centuries until it contained less than 5%. Each emperor justified the debasement as necessary. Each reduction in silver content was presented as temporary. The empire did not fall to foreign armies. It fell to inflation, to the loss of faith in the monetary system, to the realization that the coins that once represented wealth now represented nothing. The mechanism was slow. The senators reassured the public. The bankers adapted. The system held until it didn't. The British Empire did not collapse because it lost battles. It collapsed because it could no longer finance its global presence without destroying the value of its currency. The pound sterling, once the unquestioned reserve currency of the world, became a liability. And when the market recognized that reality, the empire was over. The United States is not Rome. It is not Britain. But the pattern is the same. The currency that built the empire is starting to show the same structural fragility. The debt is too large. The buyers are too few. The confidence is too fragile. And the Treasury market is beginning to reflect that reality. The phrase risk-free rate exists for a reason. U.S. Treasuries are supposed to be the one asset that carries no risk. No credit risk, no liquidity risk, no default risk. Every other asset in the world is priced relative to Treasuries. Every portfolio, every pension fund, every central bank balance sheet assumes that Treasuries are stable. When that assumption cracks, everything reprices. This is what happened in Britain in 1976. The gilt market broke. The pound fell. The IMF intervened. And Britain never regained its status as a financial superpower. The system survived, but the empire did not. The United States Treasury market is not breaking today, but it is showing the same early warning signs. Liquidity is thinning. Volatility is increasing. The Federal Reserve is intervening more frequently. Foreign buyers are stepping back, domestic buyers are overwhelmed, and the market is starting to move like a market that is no longer certain. History does not repeat, but it rhymes, and the rhyme is starting to sound familiar. In September 2019, the overnight lending market, the repo market, froze. Banks that were holding treasuries as collateral could not borrow cash against them. The market that was supposed to be the most liquid in the world could not function without emergency Federal Reserve intervention. Rates spiked from 2% to 10% in hours. The system that was designed to be self-stabilizing required immediate central bank support. The Fed injected hundreds of billions of dollars to restore order. In March 2020, as COVID lockdowns began, the Treasury market broke again. Selling pressure overwhelmed the market. Dealers could not absorb the volume. Prices fell. Yields spiked. The Federal Reserve launched unlimited quantitative easing to restore stability. In October 2023, it happened again. Yields surged. Liquidity vanished. The Fed intervened quietly. The system stabilized. Each time the explanation was different, a technical glitch, a pandemic shock, a policy adjustment. But the pattern is the same. The Treasury market, the foundation of the global financial system, keeps breaking. And each time it breaks, the intervention required to stabilize it becomes larger. This is not strength. This is fragility disguised as resilience. The dollar system is not collapsing, not visibly, not yet, but it is beginning to show the same structural weaknesses that preceded every other reserve currency transition in history. The British pound did not collapse overnight. It eroded over decades, through wars, through debt accumulation, through the slow recognition that Britain could no longer manage its financial obligations without debasing its currency. The transition from pound to dollar took 50 years. But the breaking point, the moment when the market recognized that the system was unsustainable, happened in a matter of weeks. In 1976, the gilt market froze. The pound fell. The empire was over. The United States is not there yet. But the Treasury market is starting to behave like a market that is preparing for that moment. Foreign central banks are not panicking. They are not selling all their treasuries, but they are diversifying. They are buying gold at rates not seen since the 1970s. They are establishing bilateral currency swap lines that bypass the dollar. They are reducing their exposure to an asset that they no longer believe is risk-free. This is not conspiracy. This is prudence. And prudence, in this context, is the same as distrust. The phrase exorbitant privilege was used to describe the dollar's unique role in the global economy. The United States could borrow in its own currency without limit, without consequence, because the world needed dollars to function. This privilege allowed the U.S. to run deficits that would have destroyed any other nation. It allowed the Federal Reserve to print currency without triggering hyperinflation. It allowed the Treasury market to absorb unlimited issuance without breaking. That privilege is eroding, not because of sanctions, not because of geopolitical rivalry, but because the market is starting to recognize that the debt is unsustainable, the issuance is too large, the buyers are too few, the system is too fragile, and the Treasury market is beginning to price that reality. This is how confidence dies, not in a single event, not in a crash, but in a series of small fractures that accumulate until the system can no longer hold. The market breaks, the Fed intervenes, the system stabilizes, and everyone pretends that nothing has changed. But something has changed. The interventions are becoming more frequent. The liquidity is becoming thinner. The belief that treasuries are risk-free is becoming harder to sustain. And history tells us what happens next. In Rome, the currency collapsed slowly. The denarius was debased in small increments. Each emperor reassured the public. Each debasement was justified as temporary. And then, over decades, the currency lost all value. The empire did not fall to invaders. It fell to inflation, to the loss of monetary credibility, to the recognition that the coins no longer represented wealth. In Britain, the empire collapsed through debt. The pound was backed by the credibility of the British government. And when that credibility was questioned, when the market recognized that Britain could not manage its obligations without destroying the currency, the empire was over. The transition happened in weeks, but the fragility had been building for decades. The United States is not Rome. It is not Britain. But the pattern is forming. The debt is unsustainable. The buyers are stepping back. The Treasury market is showing stress. And the Federal Reserve is intervening with increasing frequency to maintain the illusion of stability. This is not a prediction. This is an observation. And the observation is simple. The Treasury market is starting to behave like a market that no longer believes the system can hold. History does not tell us when the breaking point arrives. It only tells us that it always does, that the market always recognizes the reality before the institutions do, that confidence, once questioned, is never fully restored. The British pound was a reserve currency until it wasn't. The system held until it broke, and when it broke quickly. The U.S. Treasury market is not breaking today, but it is showing the same signs, the same liquidity stress, the same reliance on central bank intervention, the same quiet recognition that the foundation is weakening. Empires do not collapse overnight. They erode slowly, through debt, through debasement, through the quiet loss of confidence in the instruments that built them. The process is gradual. The institutions adapt. The markets function. And then, When the market finally recognizes what has been true for years, the collapse happens all at once. The event is not the warning. The reaction is, and the Treasury market is reacting.